Hello there, welcome to this week's first edition of Global Business Africa. We've got plenty of news content lined up for you, a mix of all the key business news stories you need to know about from across the African continent, from all corners of Africa, Lagos, Cairo, Nairobi and Johannesburg. Here's what we have lined up. Ebola-struck nations fear the worst unless funding gates are opened to revive their affected economies. We'll also be looking at Egypt's latest efforts to win back investor confidence. We'll be looking at the steps achieved so far. And we'll take on a journey to the fertile oasis in southern Tunisia, where dates and pomegranates are giving farmers something to smile about. Let's start tonight in Guinea, Liberia and Sierra Leone. Their respective finance ministers are urgently calling on the international community to scale up their response to the Ebola epidemic. Now, the ministers say without direct budget support, all three countries might not be able to reopen schools, much less secure the livelihoods of millions of farmers and market sellers who've lost an entire harvest because of Ebola. Growth forecasts for the trio have been drastically cut, and the World Bank has estimated that the epidemic could inflict over $1.2 billion in economic damage over 2 years. Let's get you some latest details on that particular story from Daniel Ranges, who's live in Washington, D.C. with more details on that. Daniel, what exactly would be the form of this recovery funding? Would it be the usual mix of balance of payment support and project financing from these two Bretton Woods bodies, or something completely different?
Absolutely. So if I can break it down, let's start with the World Bank. So they are providing $400 million in the capability to provide grants. So in other words, they are giving money from their emergency fund, which the donor countries have set up, which is unconditional, and it's not a loan, it's a grant to buy things, to have emergency management. At the moment, about $117 million of that has been dispersed so far. And in maybe 2 or 3 weeks' time, they'll be announcing the next round of those grants. So what happens there is the countries work with the World Bank and with some of the major aid organizations, particularly on the UN side, to identify the most pressing needs and then basically target those funds towards them. On the IMF side, this is more to do with the financing of the country. So at the moment, we've seen some extensions of current loan facilities, which are conditional. They're based on the need for countries to take certain actions to stabilize their economies in order to get that lending. Yes. Sierra Leone and Liberia both have had those extended by about 40 or 50 million. But Guinea has now received emergency relief of around $40 million, and that is not conditional.
Indeed. Sierra Leone's finance minister earlier this month spoke of the need for more flexibility when it comes to the terms on which support from the IMF and the World Bank is provided. Now, he didn't go into much detail at the press conference a few weeks ago, but what exactly does that flexibility translate to in practice?
Well, there's two things here. One is the flexibility not to impose conditions on lending or indeed grants themselves. Given that the IMF and the World Bank have some fairly sort of strict rules about the kinds of money that they put into different pots, it's unlikely that they will change those rules. It may be that they have emergency credit, in which case the conditionalities are not as strong, but on the whole the rules stay the same. But I think one of the other references to flexibility is related to the idea that the international community should be providing cash for these countries. Not just loans, but cash itself, in order to make sure that these countries can pick themselves up after the crisis. And I think when he says flexibility, he really means international community cash to rebuild these countries.
Indeed. Finally, Daniel, Guinea, Liberia and Sierra Leone were all supposed to provide a joint economic recovery plan. We know they were working on that as of 3 weeks ago. That would essentially address the recovery funding needs, where this money would go, what it would be required for. When should we expect to see that plan in detail?
Well, I think the context of this is that the World Bank came out with a very hard-hitting report that looked at the regional context of the kinds of losses that we can expect as a result of the Ebola crisis in different stages. So one would be an acute stage where the situation doesn't get resolved very quickly, and another where things happened a little bit more quickly. But in either case, they are forecasting that the impacts on the ground in the businesses, the economic sphere in these countries will be great. So I think what they were referring to there was the idea that these countries need to work together regionally in order to rebuild their economies, so they're in much better lockstep. But I don't think we're there yet. I think we're still in an emergency stage. The World Bank and the IMF very much focusing on trying to deal with the Ebola crisis head on, as are the governments. But there is an acknowledgement in there that when that crisis has been addressed sufficiently, that these countries need to move together much more closely in order to rebuild their countries with the help of the international community in a way which means that this Ebola crisis does not happen again.
Indeed, we'll have to leave it there. That's Daniel Rangers live in Washington, D.C. We'll be keeping tabs, of course, on the developing story and the economic damage that is being inflicted by the Ebola outbreak in West Africa. Let's move to the other end of the continent now. The co-hosting of the UN World Trade Organization, or rather World Tourism Organization General Assembly last year with neighbor Zimbabwe did help to raise Zambia's tourism profile, and it seems that that decision is now paying some dividends. You see, Zambia's tourism sector makes up just 2% of its entire GDP, and arrivals were just short of 1 million tourists in the last 12 months. CCTV's Farai Makutuya was in Zambia recently. While there, he spoke to Stephen Wansa, the permanent secretary in the tourism ministry.
We've seen Zambia really marketing itself quite aggressively on the international market, on various international forums. Is that investment paying off?
In sales and marketing, they say goods on show don't sell themselves. No matter how good they are, somebody has to know that they exist. So it is important for everybody to know where Zambia is, and we have to let them know. The campaigns have been there. We wish we could do more, and we'd like to do more. But it's been our desire and our set goal to ensure that as many countries as possible get to know about Zambia, and especially from the traditional source markets, which is Europe and the emerging markets in the Far East. We're looking at getting into strategic alliances with entities in those places. We can't be there, and also the cultural distance between them and us means that they'll take it when their own people tell them that it's a good place to go to. And also that would be something positive, to say about our place.
What is the current structure of the local tourism industry? International players versus local Zambians. Are they also participating in this boom?
The big hotel chains, we have quite a few here. And of course they lead the pack in the sense that they benefit from the global or single point marketing effort that goes all over. But our own people are involved. One of the problems, of course, is that access to finance, affordable finance that is, hasn't been that easy. But there's lots of people out here in Zambia that have invested in hospitality. And some of them go for the top market, but a number of them deal with the market that the top hotels don't deal with.
There are obviously a lot of successes, but I'm sure there are also challenges. What are some of those challenges, and how do you see them being overcome going forward?
I would say that one of the main challenges is the inadequate physical infrastructure. The requisite infrastructure that should support tourism development. And we need more, airports, roads, even railways in particular areas, but especially roads, in order for people to have access to the many natural as well as cultural and heritage sites that we have to offer. We need to open up the countryside. The other bit is, of course, like I said, access to affordable capital for investment.
Now, Tunisians, of course, are due to vote in parliamentary elections sometime this week, even as the country tries to secure more funds to help rebuild its ailing economy after a popular uprising in 2011. Now, Tunisia plans to raise as much as $500 million through the sale of a Sukuk bond by the end of November. It's already in talks with Citigroup, Natixis SA, Standard Chartered and Qatar-based Q Invest about the issue. If successful, this North African country will follow in the footsteps of the UK, South Africa and Hong Kong in selling debut Islamic bonds this year. According to Moody's, the sovereign Sukuk market is expected to hit about $30 billion in fresh issuance this year alone. Ethiopia's agricultural output in 2014 is expected to rise, partly due to policy changes made by the government. Now, just 30 years ago, Ethiopia was the global poster child for famine. As Girum Chalana reports, however, a lot has changed since 1984.
Exactly 30 years back, Ethiopia was painfully food insecure. It had gone through the worst famine in the history of the nation. Today, though, things have changed for the better. Agriculture today contributes to about 43% to Ethiopia's GDP. This is beyond achieving food security.
The country is recording a lot of progress in the agricultural sector. For instance, I know that there are a lot of interventions from the agricultural investment side, that is to make agriculture, more land to be farmed, more intensification of agriculture to make sure that there are diversity of crops as we go around. You see agricultural produce everywhere.
It is now harvesting season for the Ethiopian farmers across the nation, including the country's staple grain teff. Others like sorghum, wheat, barley and maize are expected to double in outputs comparing the last year's produce. Farmers I spoke to are pretty much convinced this year is going to be another successful year for them.
What we see here is a better potential of the grains, perhaps giving us the impression that we will get better harvests. Therefore, I'm so much optimistic that the result will make us all happy.
This year we are tremendously happy. While harvesting, we have seen quite a lot of change from last year's similar season. From the very beginning, the rain was appropriate. So now, we are so much happy that the result is going to meet our expectations.
As it did over the past 10 years, the agriculture sector in general is expected to grow this year as well, and it continues to cover over 90% of Ethiopia's exports. Experts, however, suggest the nation must now focus on value addition in the agri-sector so that it can play a better than before kind of role for leading the economy.
We also want to see an overall increase in the not only farmers but agro business or agro processors, so that is agriculture along the value chains increasing in terms of a number of investors, number of companies, number of firms. We want to see our food being processed locally rather than coming in cans and in sacks in different forms, processed, and we consume it when we can produce the same here.
Despite the challenges, the agriculture-led economic growth that is linked to improved livelihoods and nutrition can become a long-lasting solution to Ethiopia's poverty and provide sustainable food security. Ethiopia has an economic strategy which wants to see the industry sector taking over the agriculture one in a decade's time. That is why the country's ambitious growth and transformation plan demands government and private sector agriculture actors to stretch their hands to achieve that transformation to industry, running against time. The current growth simply tells the plan has huge potentials of succeeding. Grumtala, CCTV, Addis Ababa, Ethiopia.
We've had a bit of a mixed day across equity markets across Africa. Let's make a quick run through the numbers. Red ink from Nigeria and the AJX 30 of in Egypt. However, the JSE and the Nairobi 20-share index all did close in the green. Some highlights from there. Kenya, of course, did drag indices a little lower in Kenya. The company, of course, last week reported a 46% decline in after-tax profits. So that's something to keep a close eye on. Over in South Africa, JSE had some interesting developments. ShopRite did provide with a bounce. It ended the day higher by 7% at about $13.82 per share. Kenyan Treasury officials are to review Kenya's growth after the rebasing of the economy. And Egypt is still working to win back investors. We'll be looking at the steps it has taken to that end so far. Africa is on the move. It's home to 7 of the world's 10 fastest growing economies. We help you make sense of the fast changing African business landscape. We take you where the business is happening.
The rebasing of Nigeria's GDP has been a long time in coming.
The information provides us much more scope to know what the structure of the economy is.
Welcome back to the program. You're still watching Global Business Africa. On to East Africa now. Kenya will be reviewing its economic growth target for this year, given a rebasing exercise that was concluded in September. The central bank governor, Njuguna Ndung'u, says the National Treasury will review the previous growth target, which was based on the old GDP series, and announce new ones. Government officials put 2013's gross domestic output at about $53.4 billion. That was 25% higher than previously stated. 2013's growth data was revised up to 5.7% from 4.7%. Mr. Ndung'u said he expected the economy to remain resilient this year and in the medium term as well, mainly due to its diversified composition. He also cited a rise in FDI in transport and energy, declining commercial lending rates, and improvement in the management of spending by new local government units called counties as reasons to be optimistic. Now, over in North Africa, Egypt's Finance Minister Hani Kadri Demian says that the country could tap international bond markets to raise up to $1.5 billion in 2015. Egypt's government, of course, is still trying to repair an economy battered by 3 years of political upheaval and street protests. On What's Hot tonight, to take a look at the progress made so far in fixing Egypt's economy.
While Egypt's economic outlook has brightened in recent months with 3.7% year-on-year growth for the fourth quarter of the fiscal year, its finance minister, Hani Kadri Demian, warns it is too early to predict the effects recent reforms will have on the economy.
We're bringing the economy to the point of a high or a strong takeoff. And we're starting to see the signals, as I told you. It's a very difficult situation. And our starting point is not an easy one. But our main mission in this government is to rebuild the confidence in the Egyptian economy.
President Abdel Fattah al-Sisi's government is gaining the confidence of foreign investors by implementing politically sensitive economic reforms, such as slashing energy subsidies and raising taxes in a bid to narrow the budget deficit. But Demian says they could still tap international bond markets to raise $1.5 billion next year in order to shore up its finances. The government is open to an International Monetary Fund loan if needed.
We're open to all different sources of financing with the magnitude that we choose and with the assessment to the timing, to the appropriate timing that we can get into the markets or to have an access with the IMF. So all alternatives are open.
Damian says they will, however, turn to international markets first, but there's no firm figure on how much borrowing they will target. He predicted over the next 4 or 5 years, Egypt's budget deficit will ease to 8% of gross domestic product, after an initial target of 10.5% for 2014-2015.
Next year, there will be a very little decline in the rigidity because I have a constitutional obligation to increase spending on health sector and education services and almost double them, so bring them up to 10% of GDP by year 16-17.
Egypt hopes an economic summit due to take place next year will persuade investors that the country offers stability and opportunities in a region gripped by war and Islamist militancy. Damian said he expected to sign investment deals worth about $5 billion ahead of the event. Valdi Carlsa, CCTV.
Let's head over to Cairo now. Yasser Kim has been keeping track of Egypt's recovery for a fairly long time. He joins us now live from the Egyptian capital. Yasser, exactly what will this be? Are we looking at a conventional bond? Are we looking at a Sukuk bond? And whatever the amount, however it's raised, where exactly will the money be spent?
We're looking at the conventional bond because Sukuk has not yet been ratified in Egypt. So a conventional bond, where the money will go, it will part of it will be put into the central bank because the central bank will have to pay Qatar, will repay Qatar a debt of $2.5 billion that Egypt owed to Qatar, and the deadline is at the end of the month. So part of it will be placed to cover the money that's going to Qatar out of the central bank reserves. So another portion will be put into the reviving the economy, spending on other issues to move the economy and major projects that the government is trying to put as part of the reforms.
Indeed. In the last 3 years, however, Egypt's public debt has shot up from about 75% of GDP to over 93%, according to some IMF data. How much exactly is Egypt spending at the moment on debt service every year, and how sustainable is that spending pattern?
The numbers are quite frightening for an economy like Egypt's economy in such tough times. You've got over like $46 billion that has to be paid as foreign debt, and more than $283 billion for public debt, internal debt. We're talking about interest rates that have increased by 20% only this year. So we're talking about a lot of money that needs to be paid, and it's increasing. The problem is that the government is borrowing from local and foreign banks to pay debts. So it's actually changing debts from one side to the other, bringing more debts to pay for the other debts, more loans for loans. And this puts the country into a vicious circle, and this circle is growing. What the government is hoping is that revenue will increase in the next few years, so to reduce the debts and to be able to pay the loans without having to borrow more. With the political instability, of course, it takes a long time to revitalize the economy and also to bring more revenues. So this is the problem, and that's why it's not safe policy.
Indeed, Yasser Kim there on the vicious debt circle that Egypt is currently in. Thank you very much for that. He was live in Cairo. Quick run through commodity prices here for you. We're still keeping a very close eye on what's happening with the oil prices. What you're seeing on your screen now is US crude. It actually went under $80 a barrel. That's a 28-month low for US crude right there. Goldman Sachs earlier today, of course, did cut the Brent forecast for the year from about 100 or so down to $85 a barrel. Keep a close eye on the OPEC meeting on November 27. That should provide a bit of direction on where the market is headed next. We'll take you to southern Tunisia next. Its oases are fertile ground for dates and pomegranates. Farmers there having quite a blast. We'll tell you why next. Welcome back to the program. Now, southern Tunisia's oasis make that region quite ideal for the cultivation of dates and pomegranates. 2014 has been a spectacularly successful season too. Yasmin Ryan found this report for Grassroots tonight from the southern region of Zarat, focusing on a small farming cooperative and their successful season so far.
An oasis in the desert, full of juicy pomegranates. This organic farm hasn't been here for long. A year ago, a collective of farmers came together. Their first harvest has been a success, contributing to a peak in Tunisia's pomegranate exports.
We had a need, the maintenance of plants and everything. There was an enormous need for the entire region, so we had the idea of creating this cooperative, of bringing farmers together. We made an announcement and it all came together, just like that.
Pomegranate season began on October 15th and lasts until mid-November. Nearly half of the pomegranates come from this region, near the town of Gabes.
The exportation of pomegranates has improved this year. There's also been an improvement in the quality of the harvest. In the first 15 days of the harvest, we've recorded 2,000 tons, 90% of which goes to Libya. The rest goes to Europe and to the Gulf states.
There's still a lot of work to be done. The region of Gabes doesn't have any facilities to package or process their pomegranates, and people here hope to develop these areas to help create more income and employment opportunities.
In European supermarkets, a single fruit sells for more than 4 times the price of an entire kilo here in Tunisia. Yet most of them are still being sold in Tunisia or in neighbouring Libya because of exporting difficulties.
There are moves afoot to organise the sector more at both the national and local level. There is also a need for private investment.
The commercial network is lacking in the region. We need a platform so that farmers can be organized on. Right now, the commercial side is done elsewhere.
This community has been encouraged that their hard work is paying off, and next year they hope to have an even more fruitful pomegranate season. Yasmin Ryan, CCTV, Gabes, Tunisia.
Quick run through the currencies here for you. A lot of steady numbers coming through right across the board. The Kenyan shilling, for example, despite end-month pressure, not really moving in either direction. We are keeping a close eye on the rand, however, over in South Africa. It's under that psychologically important 11 rand to the US dollar mark. This is a data-heavy week. There's data coming out of the central bank and credit data, and of course banking sector issues as well, and labor data also coming out a little later on. Now, here's what we're working on for tomorrow's program. We'll be in Uganda. The Revenue Authority gets a new boss after a fairly long wait. We'll look at the tasks that await her. And of course, the big players in the telecom sector in South Africa opting to restructure as cutthroat competition is eating into their profits. We'll have the details on that and plenty more on Global Business tomorrow. That's it for this edition of the program. Do remember to send your feedback on this program to globalbusinessafrica@cctv.com. We're also online, Facebook and Twitter, your port of call when we're not on air. But that's it for this edition of the program. Thank you so much for watching. We'll see you in 23 hours.